Thank you. And just to pick up on the point that Jim was talking about, yield is king at the moment. We see funds in all sorts of different areas, and yield is king. They're the funds that are getting away. A lot of people are trying to raise funds, but you've got to be a good yield story. They're the funds that are getting away. A short introduction on Appleby. Appleby is an offshore law firm. We're the largest offshore law firm, and we have offices in all major offshore centres. I'm in the Guernsey office, which is why I'm speaking today. This is all pretty straightforward stuff, but the thing from a structuring perspective is that you want to make it efficient so that the returns you're generating are getting back as much as possible to the investors. And I should also say, as Jim did, I'm going to go through this so that we can ask questions of the far more interesting people who have spoken earlier. You want to get as much possible back to the investors rather than it being frittered away in the structure. And so you want to minimise the administrative burden. You need good administration, but you want to minimise that. You want to minimise regulatory compliance to the extent you can, while it's still sensible, and get as much as possible back to investors so that they'll invest in the next one. Being from an offshore firm, the onshore-offshore question is worth thinking about. Offshore tends to have greater flexibility, slightly less regulation, and a range of regulation depending on where offshore you go. Again, offshore, there is less tax leakage generally. And that's not to say that tax won't be paid throughout the structure, it's just that you can't pay tax at every level. If you pay tax at every level, the investor gets nothing. So again, it's about maximising the returns to the investors. One of the things that we're looking at for, and I'm conscious this is a diverse audience here, so one of the things that we're looking at for early stage products and technology and IP is an incubation structure. And this involves what's called a protected cell company. And a protected cell company was developed in Guernsey in the late 90s. It's a corporate vehicle which segregates assets and liabilities in cells. And the cells have no separate legal personality. They're a statutory creation, but the assets and liabilities within each cell are protected from cross-contamination amongst the cells. So because it's a single vehicle, you can put in a piece of IP, for example, get investors in, and it's a strong platform for putting in different pieces of IP from different investors on a cheap basis, which is at that stage obviously important. As I mentioned, you can raise funds between cells. If a piece of technology is successful, you can also roll it out, IPO it, do whatever you want with it, and it allows that to happen. But in the meantime, it's a nice cheap platform. In terms of fund structures, and Jim's already talked about their fund, which is a Guernsey corporate vehicle, but you're more likely to see probably VC or early stage buyout funds, which I'll come to. And from a corporate perspective, I've got a structure using another PCC, which again, just for interest's sake. So the structuring part is probably not to everyone's interest, but this is a very basic structure. Above that, you will have some more tax planning, and below that, again, tax planning. And so it looks far more complicated in whole, but at its simplest, this is what it looks like. The general partner will often be offshore, or the limited partnership will be either UK, Scottish, Guernsey, Jersey, something like that. And the corporate can be wherever it needs to be from a tax perspective. This is a corporate PCC example, and again here, this allows you to run different strategies in different cells on a platform which again assists in cost minimization. And so we've got three strategies here. You may want to mix those, you may want to do different things, it could be different vintages, but again, it's just a flexibility thing, and assists on savings cost saving. More generally, from a Guernsey perspective, notwithstanding the difficult times, the Guernsey funds industry has been growing over the last few years. We talk about 2009-4, and since then, there's been huge growth in the Guernsey funds industry. Private equity, which includes the VC and the buyout vehicles, has grown enormously over the last 5 years. And I think from a Guernsey perspective, and I am speaking from a Guernsey perspective, investors know Guernsey and it's easy to sell a Guernsey strategy. It doesn't suit every major or every situation, but it does work.